So this is the third part of the lesson, or the lecture on forecasting financial statements using Microdrive as an example, and the format used in your textbook. And the purpose of this again is to kind of walk you through it so you can see the steps and the actual work done to create the spreadsheet that your textbook goes over in Chapter 9. The first two videos covered the first tab, additional funds needed. Then the second video covered financial statement forecast. The third one, it covers alternative financing policies. And there's not a lot of work to do on here, but I do want to walk you through it. I will ask you to create an alternative finance policy. And the fourth tab is feedback. What that refers to is financing feedback. So we'll include those financing feedbacks on the next lesson. So looking at alternative financing policies, the purpose of this spreadsheet is to set a financial policy or set a different financing policy than what was in the place for your financial statement forecast. Here at the top of the page, it says that in this particular example, the financial policy plan is to let dividends per share grow at a specified rate. We didn't do that before. We set different target rates, but not a growth rate. Not change the level of existing notes payable. In other words, we're not going to issue any more notes payable. If you take a look at what we did last time on the last spreadsheet, we actually set notes payable as a percentage of investor supplied funds. We're not going to do that this time. We're going to say we're going to keep those the same. And not issue or repurchase bonds, preferred stock, or common stock. So if you think about that, how would we fund our additional funds needed? What this spreadsheet introduces is the use of a line of credit. Excuse me. Typically in business, we'll see lines of credit. These are short-term, usually a year or less, sometimes up to 3 years worth of credit that's made available to the firm as they need it. Oftentimes, firms will be issued what are called revolving lines of credit. And to kind of get an accurate idea of what a revolving line of credit is, it's like a credit card for a business, with the exception that any balance, any money borrowed against the line automatically starts incurring interest. So not like a credit card with the idea that you have a time period where you don't accrue any interest on the balances. With revolving lines of credit, the day they take those out or borrow against those, they start accruing interest on the borrowed amount, not on the entire amount, but on the borrowed amount. So what this spreadsheet does is say, okay, what are our options for additional funds needed beyond what we're going to be able to create using retained earnings or through spontaneously generated liabilities. Our options are to borrow against the line of credit, which is referred to as the LOC. And that's if we need additional funds. If we don't need additional funds, if we have a surplus of funds, then we're going to issue a special dividend. A special dividend is a dividend that's made one time. Very large dividends in the past have included Microsoft and Apple. They both have made very large one-time dividends where they want to get rid of a lot of money all at once. And that's what we would do in this case with this company. It's a one-time dividend, so it doesn't change our ongoing dividend policy. And we're not issuing or repurchasing bonds, preferred stock, or common stock. So this is how we're going to handle any additional funds needed, either positive additional funds needed where we need to bring in some more capital, or negative additional funds needed where we actually need to get rid of some of our cash because we don't need it anymore. If you look at the income statement and balance sheet, it's the same income and balance sheet that were on the previous two spreadsheets. Going down below, if you look in your book, there are two alternative policies that the management comes up with in this case. One is improve and one is maintain. The maintain would be like the status quo in the previous spreadsheet, and the improve would then be similar to the best case scenario in the previous case. So that information is just a given. You see there are no calculations for those. I want to go over in a little more detail how to use the scenario manager. So I'm going to go to data, and this is in Excel 2010. 2007 is similar. What if analysis, scenario manager. Because two scenarios have already been created, we can use those. Right now, our active scenario is improve. If I want to put that on maintain, I would just click maintain and press show. And as you can see, it switches to these numbers. On the previous spreadsheet, I didn't mention it, but down at the bottom, there were the summary of key results. You'll notice that for the maintain and the improve, these are all fixed numbers. They're not ratios, they're not pointing at anything. What they did was that they showed the scenario, or they selected a certain scenario, and I'll show you how this is done because I'm going to ask you to do it. They highlighted the results for that scenario, right-clicked, press copy, and then right-click again and press paste special. When you do that, when you go to paste special, you want to paste the values. The reason why you're doing that is you don't want the formulas to carry over. You just want to have those standard values there. So let me go through an example here. I'm going to delete both of these. I'm going to go to data analysis again, or data, what if analysis, scenario manager. First one I'll do is maintain. I'm going to show that. So the scenario now in the model is maintain. I'm going to highlight those. I right click to pull up this. I left click on copy. I right click again and go to paste special and go to values. Again, it's because we don't want to just put in the numbers that are in, or the formulas that are in here. Let me show you what happens if we do that. So if I select improve here because I want to find out the outcomes if things improve. And then copy. But this time I'm not going to paste special. I'm just going to put paste. So that's what we get if we just put paste. So we don't want to do that. We want to use paste special. Go to values. And so that gives us, oops, gave me more than values. Gotta make it look better again. Go into Format Painter. Probably won't like, yeah, I don't like that. Okay, let me try this one more time. There we go. Alright, so we have our different outcomes. As you can see here, we already did this on the previous page, so you can see the calculations, you can see the formulas. So I'm not going to go through each one of these again. You can see what we did on the last lesson to show how those are calculated. Again, the same thing down here. You can go to the last lesson to see how these are all calculated for the statement of cash flows. On the right hand side here, the forecast uses the same formulas as the actual, but then uses the points to the results for improve, in this case, or maintain. We'd actually use these numbers, the scenario now in the model, to calculate these. So let me show you. For the forecasted year, we have the net income before preferred dividends equal to 156.8, and that is in cell F135. So I'm going to go to cell F135. Okay, so over to F. So this amount is calculated using the scenario that we're in. What the scenario changes, and I'll show you this again, is I go to data. So right now it's in improve. I want you to watch this column here. What if analysis scenario? We're going to change it to maintain. So again, watch this column, the factor or rate. Okay, so you see that how that changed all these numbers. Oops, these numbers here are linked to these numbers over here. Okay. To briefly go through this part of the spreadsheet, the way these are calculated, this is planned without the additional funds needed. This is the additional funds needed adjustment. If we're maintaining our current situation, kind of furthering the status quo, but with these financial policy constraints put in place, we're going to need $109.3 million for the next year for additional funds needed. You can see they make the additional funds needed adjustment here. Otherwise, our financial statement, our balance sheet does not balance. We don't like that. We want to make that balance. So this is programmed to give the calculate the additional funds needed. You can see the calculation here, and to create a line of credit for that. Right. So this is planned without the additional funds needed. This makes the additional funds needed adjustment, and this is with the additional funds needed put in place, a balance sheet that balances. What we don't see in this spreadsheet is the financing feedbacks. So what are the financing feedbacks? So what are the financing feedbacks? The financing feedback for taking out more debt our financing feedback would be the increase in interest expense. Actually, I'll go down one here. And that's going to result in a lower net income, resulting in a lower my hands get a little bit faster than my brain here. A lower net income, resulting in a lower addition to retained earnings. And then we know that those retained earnings, that addition to retained earnings, is used to reduce the amount of additional funds needed. So what happens if we lower our addition to retained earnings? We end up needing to add additional funds needed. And then from there it's a vicious cycle. That looks a little better. So for taking out more debt, the financing feedbacks are an increase in interest expense. That results in a lower net income. That results in a lower addition to retained earnings, which results in an increasing additional funds needed. How are we going to fund that? We're going to take out more debt, which is going to, again, increase the amount of interest expense that we need, or the interest expense that we have, lowering net income, lowering the addition to retained earnings, and then again increasing our additional funds needed. It's kind of this vicious cycle. We call it an iterative cycle. We're actually going to deal with that in the next spreadsheet, where we address the financing feedbacks. For now, though, we don't address them. If you see here, the interest on the line of credit is not included in the calculation. So we're not going to worry about that right now. In the next spreadsheet we will. To go over the financing feedbacks for issuing more stock. If the stock pays dividends, and that's kind of the key here, if it pays dividends, the total amount of dividends will increase. And that results in a lower addition to retained earnings, and resulting in increasing additional funds needed. So again, we don't incorporate those outcomes into this spreadsheet. We're going to do that in the next spreadsheet. The last thing I want to show you here is the calculations here. Again, what we have is these two columns of results: free cash flows, return on invested capital, so on. I showed you how to calculate those in the last video. You see that these are static amounts. To get these amounts, you would do what you did before. Well, what we did before, which was run the scenario, get the results from this column, and then do a special paste using just the values into these columns. That should kind of finish up this spreadsheet. Again, not a lot of work on this spreadsheet. Let me just demonstrate one more thing. I want to show you what it changes whenever we go to improve. So I'm going to go to improve here, show that. What we see when we go to improving this is that we have a special dividend. In other words, we had negative additional funds needed. We generated more cash than what we needed, and we paid that out as a special dividend. And fortunately, that special dividend doesn't really have a financing feedback. We just get rid of the cash, and there's no additional funds needed, or no increase in interest expense or dividend expense in the future. The next presentation will be on the forecasting feedbacks.